The last time this many red flags popped up, Wall Street lit up like Times Square, right before going dark. Seriously, this isn't your typical buy the dip warning. We're talking about a perfect storm, soaring valuations, rising interest rates, crushing debt, psychological panic, and a tech-fueled bubble teetering on the edge. You can almost hear the financial Jenga tower wobbling. So buckle in, because in this video, we're going to break down exactly why a stock market crash might not just be possible, it might be inevitable. And no, this isn't doom for the sake of drama. These are the real signals, real trends, and the eerily familiar patterns that history keeps screaming at us to pay attention to. Let's dive into it. Let's start with the obvious. The stock market is stupid expensive. The S&P 500's price-to-earnings ratio is over 27. For context, the historical average? Around 15 to 16. Translation: we're paying luxury prices for economy performance. Tech stocks are once again the ringleaders, led by the AI boom that's inflating prices faster than a crypto coin in 2021. Companies like Nvidia and Microsoft have seen their valuations jump 50% to 100% in a single year. Not because of revenue, not because of net income, but because of AI. Investors are acting like AI is about to cure cancer, end global warming, and do your taxes, all at once. And while AI will change the world, that doesn't mean the companies riding its hype are worth 30 times earnings. Valuations like this scream bubble. And bubbles always pop. But what happens when the bubble isn't just tech? What if the entire economy is floating on borrowed time and borrowed money? Let's talk about debt, the lifeblood of every modern economy, until it turns into a tourniquet. Right now, consumer credit card debt has smashed through $1.3 trillion. And delinquencies are quietly ticking upward. People aren't paying off their bills. They're rolling them at 20% plus interest. Meanwhile, U.S. government debt is approaching $35 trillion. Just take that in for a second. That's $100,000 per citizen. And the interest on that debt? It now costs more than the Department of Defense. We're literally spending more to pay off interest than we are to fund the military. And let's not even talk about corporate debt. Companies have been refinancing at rock-bottom rates for years. And now that the Fed jacked interest rates up to fight inflation, that mountain of cheap debt is turning into a financial hangover. Zombie companies, the ones that only survive because of low borrowing costs, are starting to rot in the daylight. So we've got a bubble and we've got debt. But surely the Federal Reserve is here to save the day, right? Not so fast. The Federal Reserve is like that exhausted firefighter trying to put out one blaze, while two others erupt behind him. For 2 years, they've been aggressively raising interest rates to combat inflation. But inflation's been playing hardball, refusing to drop below 3%. At the same time, GDP growth is slowing, consumer confidence is dropping, and housing affordability is tanking. Here's the dilemma. If the Fed pauses or cuts rates too soon, inflation could spike again. But if they keep raising, they risk snapping the economy like a dry twig. They're caught between the jaws of stagflation, low growth, high inflation, the economic version of being slowly strangled while on fire. And historically, the Fed almost always goes too far. Soft landings are a fairy tale, hard landings are history. And if the Fed's walking a tightrope, guess what? The yield curve just set the safety net on fire. If you're not familiar with the yield curve, it's basically the difference between long-term and short-term interest rates. Normally, long-term rates are higher. That's healthy. But right now, it's inverted. Badly. Short-term Treasury yields are higher than long-term yields, and they've been that way for over a year. This inversion has preceded every U.S. recession since the 1970s, without fail. It's the bond market's way of screaming, "Recession ahead." And it's not a subtle signal anymore, it's a red strobe light. Still think the crash is just a YouTuber's overreaction? But don't worry, it's not just math and charts that signal a collapse. Sometimes it's good old-fashioned human panic that breaks the system. Market crashes don't start with earnings reports. They start with whispers. A few traders get nervous. A couple funds quietly pull out. A big-name investor sounds the alarm. Suddenly, you have a cascading avalanche of panic selling. Fear spreads like wildfire, especially when the average investor is over-leveraged, overexposed, and underprepared. And we're seeing the early signs now. Record outflows from stock ETFs, a surge in gold and cash positions, and retail sentiment surveys showing the lowest confidence since COVID. Markets are emotional. And right now, that emotion isn't hope, it's hesitation. And when hesitation turns into herd behavior, what happens next can make the whole economy tremble, especially when AI is pouring gas on the fire. Let's be clear, AI is revolutionary. But revolutionary tech has a nasty habit of dragging us into speculative mania before we see real-world payoff. Think dot-com bubble. Back then, anything with .com in the name could IPO with zero profits and sky-high stock prices. Sound familiar? Today, it's any company whispering the words artificial intelligence. AI stocks are trading at nosebleed levels. Nvidia has tripled in value in a year. Microsoft is valued like it's running the entire future of civilization. Meanwhile, smaller AI startups with no revenue are being scooped up like gold coins during a rush. It's not about business fundamentals, it's FOMO. Fear of missing out, fear of being late, fear of being the one guy who didn't bet the house on the next big thing. But what happens when earnings disappoint? What happens when one of the giants misses expectations? The house of cards falls, just like in 2000. So the market looks like a ticking time bomb. But surely this is all unprecedented, right? Actually, no, it's eerily familiar. Let's roll the tape. 1929, stocks soared, debt piled up. Everyone thought the economy had reached a new permanent high. Then came Black Tuesday. 2000, tech stocks became the hottest ticket in town. PE ratios made no sense. Sound familiar? 2008, real estate and financial institutions became bloated and reckless. Leverage exploded. The Fed tried to contain it. It failed. Each crash had its own flavor. But they shared common ingredients: euphoria, overconfidence, massive debt, and systemic risk. We are not in a unique situation. We're in a repeat, only this time the risks are global, digital, and harder to contain. So, if history is our guide and fear is rising, what should you be doing right now to survive the next crash? This is the part where you don't panic, you plan. Step 1. Reassess your risk. If you're 90% in high-growth tech, it might be time to rebalance. Step 2. Diversify. Defensive sectors like healthcare, utilities, and consumer staples hold up better during downturns. Step 3. Build a cash position. Cash isn't sexy, but it buys discounts when everything's on fire. Step 4. Stop chasing hype. Just because everyone's buying it doesn't mean it's smart. Remember, sheep get slaughtered. Step 5. Think long-term. Markets always recover, but only for those who didn't blow up their portfolios trying to time the bottom. And if you're in for the long haul, crashes are a gift, but only if you have the capital and the courage to buy when others are screaming. So, will there be a crash? The signs are there, the signals are blinking, the history is echoing. Nobody can predict the exact day the floor falls out. But ignoring these warning lights would be like ignoring smoke pouring out of your engine at 80 miles per hour. So ask yourself, are you ready? Is your portfolio crash tested? Or are you one tweet away from financial freefall? You don't have to panic, but you do have to be smart. If you found this video eye-opening, hit that like button. It tells the algorithm this video is worth showing to others. Subscribe for more brutally honest, no-fluff breakdowns of what's really happening in the market. And tell me in the comments, are we due for a crash, or is this just another dip on the way up? Either way, you'll want to be on the right side of history.